right, guys, today we're sitting down with Mark Vann. He's with the Moore team. We absolutely love working with him. A major component, of course, of the home buying process is got to get pre-approved, right? And so that can be kind of a daunting and scary process. But this guy, he always makes it so seamless and easy for all of our clients. And we're just going to kind of break it down so it's super simple and easy for our clients to understand how to get pre-approved, how to buy a home here in Atlanta. I'm sure as a buyer, you have some questions, and I'm just going to pretend that I'm a first-time home buyer, right? So what can I expect in terms of, like, what do I need to buy a home? What kind of funds should I have set aside?
Gotcha. Well, as a first timer, you've got lots of options. You can do anywhere between 3% down, 5% down, 50% down. That's cool. You know, whatever. But 3% down is the bare minimum for a first timer.
And are there any deals for first timers? Any kind of like programs? I have a lot of clients ask me this.
Yeah, so there's lots of stuff out there. We work with a couple of programs where you could get some discounts on your PMI, you get some discounts on your closing costs. So not everyone will qualify those because there are income restrictions and there's always a catch, but there are a few things out there to help out.
So a lot of words that you probably may not know already. PMI, what's PMI?
Right, so Fannie Mae and Freddie Mac, they're where you get your conventional mortgages from. So they basically insure the loans up to 80% or 20% down. Doesn't mean you have to put 20% down. It just means that your payment will be a little bit higher if you don't. So we get the PMI to help supplement, you know, Fannie and Freddie's insurance on the loan. So basically it just makes your payment a little bit higher.
So in order to avoid PMI, you're putting down at least 20%.
At least 20% down.
Okay, cool. And a lot of people can't do that. That's totally fine, but just know that you're going to incur an additional cost if you don't put down 20%. And then you also mentioned closing costs. What's like a simple way for us to understand that?
Yeah, so closing costs are simply just folks that have to perform services to actually get the loan, to actually get to the closing table. Like the closing attorney has to charge for all their various stuff. The state of Georgia has their hands all in there, so that's exciting for them.
Property taxes.
Property taxes, if you set up an escrow account, have to be in there. There's just a lot of stuff. The appraisal. Each lender will have a couple of fees.
Right.
All those things together we call the closing costs.
So you've got your down payment, right? So you're, like you said, either putting down 3%, 20%, 50, whatever you want to put down, but then you've got closing costs, and that's normally what percentage of the sales price?
So depends on the sales price and depends on the property taxes, but I think a good percentage is somewhere around 2 or 2.5% of the sales price is usually get you there.
And in this market, we are actually asking sellers to contribute to those closing costs, which is pretty cool. So if you're a little cash sensitive, which is like a nice way of saying don't have a lot of cash at the bank, we can certainly ask the seller to contribute to those costs, which is awesome. Or during the transaction, when we're doing your inspection and maybe we discover something that's going to be a little costly to repair, we can ask the seller to give you some cash to cover that repair cost. So what about my credit? A lot of my clients say, you know, what does my credit need to be to purchase a home? Also, are you going to be pulling that? Is it a hard pull? Debunk those myths.
Gotcha. So that is a very common thing. I think I get asked that more than
Yeah.
anything else.
Same.
The real story on your credit is you must get your credit pulled to get a pre-approval. And it is absolutely okay if you want to shop around a little bit. I don't love that, but it's okay. I always encourage everyone to shop around a little bit. But if you have your credit pulled by multiple lenders within a short amount of time, like say 30 days or something like that, it doesn't ding your credit every single time.
Okay.
So it's okay to talk to a couple of different lenders. It will only hit your credit once.
Okay.
Okay.
Is it something that I might notice? Like it's going to be a pretty significant ding?
Not really. It depends on lots of different things, but it's only like 5, 6, 7 points or something like that.
I wouldn't notice that,
So, no.
but I don't notice a lot of things. So there's a million lenders in town. I know a lot of my buyers get hit up constantly. How would you recommend someone goes about selecting a lender that makes sense for them?
So you would want to make sure that the person that you're talking to, obviously you get along with them. You know, personality definitely has a lot to do with it.
A vibe check.
A vibe check. Rates and fees also have a lot to do with it too. Obviously you don't want to go with someone who's the most expensive if everything else is the same. But the other thing that I think can really help more than anything else is someone's experience level. Like I say, you don't want to deal with someone in anything that is their first time. A lot of the out-of-state lenders and online folks and, you know, different folks that aren't as experienced and as conscientious let that stuff slide, and then your buyer's left holding the bag.
Yeah, or they having to pay some earnest money or something like that. It would just be horrible. It's happened, you know, inexperienced lenders or lenders who work out of state who don't understand Georgia practices can be really tough, you know, or discount lenders. So like, I'm not gonna name them, but we've all heard of the discount ones that promise all these things. Guaranteed, guys, any lender that we refer you to is gonna be able to beat them. Even if it sounds like they might not, they kind of disguise their benefits essentially by like actually not, you know, it's like it's all smoke and mirrors with these discount guys.
What we like to say is usually we can match or beat anyone out there, or at least get close enough to where it doesn't matter.
Yeah, which is all that matters. And you want someone local, guys. Truly, you want someone who's here and is experienced like Vann. So interest rate, you kind of mentioned that a little bit. What is that? How do we refinance? All those things.
You know, interest rates come and go. I've got to get in my hokey saying, please let me say it.
Say it.
You marry the house and you date the rate. That's a common thing. You know, we love to have fun with that saying, but it's very true. You know, back when I first got in the business, you know, rates were a lot higher. Like your parents, like my parents, all had rates that were much higher. And rates come and go all the time. Depending on what's going on in the economy, you know, things come and go. Right now, rates are kind of in an up cycle. You know, I would assume that, you know, in the next couple of years, rates will be cycling back down sooner rather than later. I hope, we all hope, but.
Which brings more competition and just, it's cyclical.
Yeah, it's very cyclical. Refinancing, if you close on a mortgage, we like to say that you make at least 6 payments before you actually turn around and do a refinance. But basically a refinance is where you enter in a new loan to just replace your existing loan.
Okay.
So like if you bought your house and your interest rate was 6.5 and it's a year down the road and now interest rates are in the 4s, you can do a refinance to pay off your other balance and replace it with your new interest rate. There are closing costs. It takes about, you know, 2 or 3 weeks to get that process done.
Okay.
And, you know, most of the time, like, oh, you got to have closing costs to do a refi? Well, yes.
People got to get paid.
People got to get paid. The closing attorney's got to do it again, that kind of thing. You got to order another appraisal, that kind of thing. But your payment's usually going to go way down, or you're going to pull out cash, or you have some other reason why you want to do that. But there are costs involved, but usually it's a good thing.
You mentioned at the beginning how property taxes are paid. Can you kind of explain that and what people can, in terms of, and you said it goes into an escrow account, but where is this mysterious account?
That's probably one of the most common. Your escrow account is simply a savings account with the lender to pay your taxes and insurance going forward with the loan. Okay. So you're paying into the escrow account every single month when you make a payment. 1/12 of the insurance and 1/12 of the tax bill is being saved every month.
Okay.
And then when the tax bill comes out, your escrow account gets a copy of that as well, and they cut the check directly to the tax municipality to pay your taxes for you. Cool. So you're paying it every month. It's just going to build up so that once the bill comes due, they stroke a check.
When the bill's due, I don't have to worry about it, essentially.
You will get a copy of it in the mail, which obviously brings out some anxiety if it's your first time.
Right.
Hey, I just spent all this money at closing. Now I have this $3,000 tax bill. Please tell me, Vann, I don't have to pay that. Right. Well, when you set up an escrow, they're required to send that to you every single month. It's just that it's for your viewing pleasure. That's what I like to say. And so your mortgage company has a service that gets a copy of that as well. And so they actually keep up with all that and they pay the bill on your behalf.
Okay, cool. Makes sense. Actually, not so bad, actually. Anything you want to touch on with homestead exemption?
So homestead exemption is a really cool thing. It's simply a savings for living in your house as your primary residence, okay? And so you—
Not an investment.
Not an investment. If you had 2 houses side by side, they looked exactly the same, tax bill was the same, your taxes would be cheaper on the one you actually occupy, a little bit more expensive on the one that you rent.
Makes sense.
Makes sense. So you just have to simply file for that not each year, just the first time, and then it stays on over and over and over and over. But usually the deadline, depending on where you are in the metro area, is usually April the 1st. And as long as you file by April the 1st, it's retroactive for that year.
Great. So it's a big old tax break, essentially, for having it as your primary residence.
It can be up to 20–30%.
Damn. That's amazing. So to put it simply, you need to work with a lender, a local lender preferably, and get your pre-approval letter in order to submit an offer on a home, right? The pre-approval is going to last for 3 months, right?
So, you know, your credit report in the system usually lasts for 4 months.
Okay.
That doesn't necessarily mean with us. I mean, we have some tricks that your pre-approval won't necessarily expire per se if you're just looking for a while, but your credit report is technically good in the system for 4 months.
Right. Another thing to remember is once you're under contract, there are several contingencies that protect you as the buyer. Obviously, due diligence, but then there's financing contingency. Can you kind of just briefly speak on that?
Yeah, so basically your financing contingency is your period of time in the contract that you have to receive loan approval and, you know, make sure everything's gonna be okay with your loan. And so it's our, you know, sole mission before anything else, before the closing date, before anything else, is to make sure that we have that approval in place by the time that period is up. Because once that goes past, a buyer's earnest money is then non-refundable for financing reasons.
That period is established with, you know, you, the lender, your agent, who are trying to probably be competitive. In a competitive market, you might do what's a standard 21 days for that contingency period. But
what?
Honestly,
21 days?
But we've been waiving that in the last 2 years. We've been doing 0 days, or if they're already through underwriting, you can do 0, because we know that, you know, they're as good as gold in terms of their loan. But I would say, like, yeah, 10 days, 14 days in this current market. But there's also the appraisal contingency period. So your lender, Vann, he's also going to be ordering that appraisal for you. So you don't have to worry about it. You do pay for it, but Vann's going to order it for you. Appraiser comes out. That's another contingency period that you're protected in the contract.
Yeah, definitely. Like, that's a big one, because if for some reason the appraisal came in low, you'd want to be able to have the ability to renegotiate the contract and you guys work your magic.
Well, because the bank's essentially not going to lend you more than the home's worth.
Right.
Yeah, to them.
Yeah, we're going to have your 5% down or your 3% down or your whatever. If the appraisal comes in low, then, you know, that gets out of whack and we have to bring that back into the way it needs to be, basically.
Well, guys, that's essentially it, and it's quite a bit, right? The financial piece of you buying a home is obviously the biggest piece.
Complicated.
We hope that, you know, this was easy, and, you know, we are both here for you. Whomever you choose to work with you as your agent or lender, we hope it's us. But you want someone who's going to be able to walk you through the process and answer all the questions that you have. No question is a silly question. It's the most important financial decision you've likely made in your life. So we're here to support you and guide you from start to finish, all the way to the closing table.
This has been fun.
Hell yeah.
We need to do this more often.
Yeah, go team. Bye, guys.